Welcome back to se- welcome back to a session of not so pressure point ophthalmology. So for the last 1.5 months, 1.5 days, sorry, last 1.5 days we have learned how to practice our ophthalmology well so that we make money out of that. We also have learned how to keep your mind simple. We have also learned how to keep your body healthy since morning. And we have also learned how to kind of do some farming and keep your habits growing. But this is something which is not taught in our curriculum, and it's not something that we learn systematically. Is how to make our money grow, which is very important. Unless the money grows, you will not have a very happy life. And retirement is something which will keep on postponing beyond 55, 60, 65, 70. So at some point of time you have to think of a happy retirement. Retirement doesn't necessarily mean that we kind of stop working, but it may mean that you stop working for the sake of money. So for that to happen, your money actually should start making more money when you are not at work. So to do that, we have excellent speakers who not only preach but also practice. So these are the people who've been practicing. We are not from the income tax, so we can't really ask them how much money they have made. But definitely they have been practicing very healthy financial principles, and it's always wise that we pick up some pearls from them. So our first talk is from Dr. Arun. So he's going to talk about baby steps into stock market investment and trading. So one of the few things that we need to put a disclaimer is that we are not SEBI registered, or we are not somebody who is trying to sell a product here. We are just trying to educate some amount of financial education here.
Good afternoon, friends. Shailesh, we wanted to know how to make money. So, thank you. Good afternoon, and we start our session. Thank you, BOS, for giving me this opportunity. So it's about baby steps. So I'm just starting with the baby steps. I think as we progress, I think it will be more advanced later. The disclaimer. Let me start with 4 very important personal finance statements, and very powerful ones. Do not save what is left after spending, but spend what is left after saving. Second one says, he who buys what he does not need steals from himself. Never spend your money before you have it. You don't have to see the whole staircase. Just take that one first step. So these are very powerful statements. Now, this brings us to this question, why save? Why should we save? I'll give you 5 reasons. I think most of it you all know, but still. Long-term security. Saving money is a step towards financial independence. Saving money enables you to take calculated risks. Saving reduces stress. And finally, the most powerful of the lot, compounding effect can make the money to grow. It's like another pair of hands working for you. Now, do we save every rupee we earn? No. That brings us to this question, how much to save? I've given 3 formula. Saving 15% of one's annual income every year. Second one, about 7 to 8 times of one's salary by the start of 160. You have to calculate the salary you're going to draw at 60, and about 7 to 8 times. And third one is a 30x rule for a comfortable retirement. The total saving should be 30 times one's current annual expenditure. Now, when it comes to investment, so I've given comparison between a fixed income, a fixed deposit, and an equity. Because we can just put the money in FD and say that, okay, I have saved money. But why we should think of equity? I request you to take your attention to those 2 circled things. One is the inflation adjusted return. That's where the markets come in, or the equity comes in. And second thing is the minimum investment is very less. You can even start with 500 rupees. Do we need to save everything in equity? That means we take everything and put it in equity. That brings us to asset allocation rules. One of the most basic principles of investing is to gradually reduce the risk as we get older. It is also important to put the money to work and earn when we need to slow down and enjoy the benefits. For years, a commonly cited rule of thumb has helped simplify asset allocation. According to this principle, you have to just 100 minus whatever is your age. that much you have to put in equity. But this 100 has been there for a long time, but with life expectancy going up and up, so even 110 and 120 are coming into picture. The risk appetite has to be there to make it 120 minus your age. Then next is this important word that is called diversification. So diversification is very important. I think 2 days back, all of us know, because if the entire world was sitting with one company, what happened? The Microsoft outage, the entire world was at standstill. So diversification is very, very important. So you should have your assets put into funds, that is cash balances, real estate, gold, bonds, currency, stock market, everything. You should have the complete menu in front of you. Now, asset allocation, this is a study of 3-year performance, 5-year performance, and 10-year performance. So the distribution into equity, debt, and gold of 70, 20, and 10 has worked very well. Earlier, we used to talk about only 60-40, 60% in equity and 40% in debt. But after 2020, this has become very important to put something in gold. So about 10 to 20% in gold always makes it very balanced portfolio. Whereas a 34-33-33 ratio gives a very volatile but a steady long-term return. But if you are moderate risk appetite, if you have a moderate risk appetite, it is better to go for 60-30-10 and or 70-20-10. Now 10 reasons to start investing in stock market. To keep pace up with the inflation. I said inflation eats up whatever you earn from an FD. So if you keep pace with inflation, it is better to go into stock market. Most capital growth potential is there in stock market. As the companies grow, you keep growing your money. Investing makes your money work for you. Stock investing requires as little amount as buying a burger. I don't say that you keep only a small amount and wait. It is like you can test waters by investing a very small amount and see whether you can manage with that. And then later on go higher and higher. You do not need to be genius to invest in stock market. Okay? You have to be smart. Investing in stocks is a lot easier now with a lot of knowledge available, a lot of YouTube videos, etc. So you can see and learn. Tax benefits, I think this varies every year with policies. You do not always have to pick hidden gems. Don't think of a company which grows very large. Keep into small companies which can deliver good amount of returns. To create an alternate source of income. And the power of compounding. The power of compounding is really huge. This slide, I think, has been circulating. I think many of you must have seen this in the last 2-3 days. It's circulating in most of the WhatsApp groups. In 1992, I finished my MBBS. Imagine if 1993, if I had put 10,000 rupees there, today I would have had 18 crore rupees in my pocket, and I think I wouldn't be standing here. Right. Then next is, when it comes to market, we start thinking about 2 ways of thinking about it. One is trading, and another is investing. Trading, it's a short-term thinking, a profit mindset, volatility will be there, technical analysis are the tools you use, buying and selling. The trader buys and sells, and he builds a capital. Whereas in investing, it's a long-term perspective. It's the growth is the mindset, stability will be the key there, fundamental analysis is the tools, then buying and holding. You have to buy and hold the shares, and he grows his capital. Investing involves a chance of losses. However, there are ways to lower our risk, though we cannot eliminate it. Progress slowly, learning at each step, from mutual funds to ETF, then stocks, and finally, you can go into FNO. Now, how to start investing? 8-step guide. Set clear investment goal. The first step is to set your goals. Begin by specifying your financial objectives. Clear goals will guide your investment decisions and help you to stay focused. You can have short-term goals like buying a car or something of that sort. Long-term goals, which can be your retirement. Tips: be precise about your objectives. Determine your investment horizon. Evaluate your finances. Rank your goals. Adapt as life changes. Determine how much you can afford to invest. This is the second step. Pinpointing how much we can afford to put in stocks requires a clear-eyed assessment of your finances. Review your income sources. Establish an emergency fund. This is very, very important. Keep some amount for emergency, or don't use that into the stock market. Pay off those high-interest debts, especially the credit card bills, the loans. You clear off, then you come into the stock market or the equity investment. Create a budget. Again, I am putting into two crucial points here. Only invest the money you can afford to lose. Never put yourself in a financially vulnerable position for the sake of investing. People take loan and invest in stock market and get into trouble. Never ever do that. Now third, determine your tolerance for risk. Understanding your risk tolerance is a cornerstone of investing. It helps you to align your comfort level with the inherent uncertainties of the stock market and financial goals. Self-assessment, consider your time horizon, gauge your financial cushion, align investments with risk levels, adjust over time. Determine your investing style. You can either do it as a do-it-yourself type of investing, or you can go for professional guidance. You can go into mutual funds. You can go into PMS. There are different options available. Now choose an investment account. I think this is easier now. You can have a broker who has account fees you have to check, his commissions, and whatever the extra added features he is going to give. Pick up a broker. Then fund your stock account. This is the easiest of the lot. There are different ways of doing it. Like you can put one-time transfer and then go for an STP from that, transfer from a fund and make an SWP, or set up an automatic contribution. Every month you contribute a particular amount. This is called SIP. You can do this kind of investments. Pick your stock. This is very, very difficult job of the when you enter the market. Even the experienced investors struggle here with the best of the stocks. Beginners should always look at stability, strong track record, and the potential for steady growth. Resist the temptation to gamble on risky stocks, hoping for a quick windfall. Long-term investment is mostly slow and steady and not fast and rash. The type of stocks, you can go for blue chip stocks, you can go for dividend stocks, you can go into growth stocks, defensive stocks, ETFs, etc. Now this is the final step. Learn, monitor, and review. As stock market changes, staying up to date, going back to step one and revise whatever you have done and reviewing your goal, this has to be done regularly. I put this lion here because in Kannada it is called Simhavalokana. Simhavalokana means that's how a lion walks. It goes 4 steps front, stands over there, turns back, looks around, and then again goes front. That's how you should be in the stock market. Move a little bit front, again reassess yourself, see what you're doing is right or wrong, then proceed further. Always keep reading, read widely and regularly. Use stock market simulators. These are backtesting tools. You can use your strategy on that and find out whether it will be profitable. And learn about diversification. So these are the important steps you have to do. And the only mantra in stock market is discipline, discipline, and discipline. Thank you. Happy and safe investing. Thank you.
Yeah, Dr. Bhargav had to go for some reason downstairs. He will be back soon. So he has asked me to continue with the talk. First of all, thanks to Bangalore Ophthalmic Society. And thanks to all of you for being here on Sunday afternoon at this time. So now that Dr. Arun has told you how to plan our investments, he has explained in detail about the various avenues for investing and all those things. So once we decide that we want to take the direct equity approach, how do we go about? So these are my disclaimers. Additionally, none of the whatever I am presenting in this talk is a recommendation. First of all, I would like to thank Dr. Ram. He's the founder of WealthCon. He's a radiologist from Mumbai. He has been instrumental in financial education of many doctors. I'm indebted to him for my knowledge. So once we want to enter stock market, what is stock market? It is like any other market where we can buy and sell goods. Here we buy and sell stocks. So in India, there are 2 stock exchanges, Bombay Stock Exchange and National Stock Exchange, where various companies are listed. These companies can be bought and sold by people like us and also by other institutions. So there are more than 5,000 companies in India which are listed in these stock exchanges. So these stocks can be bought and sold by individuals like us as well as institutions. So all of us are investors in this company. So basically, investors are like part owners of the company. We take a pie of the company. And the transactions are facilitated by brokers. And all the transactions in India are regulated by SEBI, that is Securities Exchange Board of India. So relatively, these transactions are safe compared to unlisted stocks. There are companies which are not listed on the stock exchange, but still they can be bought and sold. But these are not regulated, hence they may not be very safe. We also should know what is primary market and what is secondary market. Primary market is when the company issues shares to the public in process called initial public offering, whereas secondary market is one where we trade in the stock market. So every investor will have 5 questions. Dr. Arun has already touched upon how to buy and how much to buy. Other questions are what to buy, when to buy, and when to sell. Which stock to buy, and when to buy that stock, and when we should sell. So I would like to touch upon these 3 questions. So if you ask the question what to buy, if you do a Google search, there are so many headings under which you can get knowledge about which stocks to buy, how to select stocks. There are so many headings. If you go on social media, there are so many influencers who give gyan or knowledge, and it's all confusing for us doctors. We are as it is, we are busy in our practice, so spend more time on learning all these things. It's very difficult. And legendary investor Warren Buffett gave these 2 rules. Rule 1 is not to lose money, and rule 2, don't forget rule 1. So keeping these rules in mind, we have to decide what to buy. So how do we decide? We have to buy good companies. What are good companies? Companies which are stable, that which are those which are making profit over a period of years, so that they will not go bankrupt, and also they should be growing over the years. In future also they should continue to grow. Then only they will make profit for us. We have to select about 15 to 20 such companies and buy them. Why 15 to 20 companies? Because we need to diversify our risk. Any one company can stop making profit in future and that can go down. So if we have 10 to 20 companies, that risk is reduced. And also it is easier to track these companies. And we can select 2 companies from about 10 sectors, so that makes 20 companies. How do we analyze which company to take? Mainly there are 2 methods of analysis, fundamental analysis and technical analysis. In fundamental analysis, we analyze the financial performance of the company and the various other parameters. Whereas in technical analysis, we look at the graph of the price movement and we can decide when to enter. Normally for long-term investing, we use fundamental analysis, where we look at the previous financial performance of the company, how the company has been doing over a period of past few years. And we also have to look at the quality of management, whether the management is working in the interest of the investors or they have some ulterior motive of making profit for themselves, is something we have to look at. And also the future prospects of the company, whether the company will continue to grow in future or will it stop growing. And company's valuation, that is whether the price we are paying now for this company is fair for the returns that is going to generate in future. How do we get this information? Most of the financial information is available in the annual reports of the company. Annual reports are published every year by all the companies. And in these annual reports, the important statements that we have to see are the profit loss and balance sheet. Going through these statements will be complex because there are so many parameters which are important in the performance of the company. So it may be difficult for people like us and time consuming. Is there anything simple that we can do which can be less time consuming? So there is something called MPTDS criteria. Basically, these criteria are designed to select fundamentally strong companies or eliminate companies which are not doing well. So what is MPTDS criteria? First one is market capitalization. I will be touching upon this in the next slide. Market capitalization should be more than 10,000 crores. Second one is price of the chart, the price chart of the stock. The price should be moving up over the past 10 years. Next is the tax paid by the company, the dividend paid by the company to the shareholders, and the sales by the company. All these parameters should be increasing over the past 10 years. So where do we get these parameters from easily? There is a website called screener.in from where we can get these details. What is market capitalization? Basically, market capitalization is the value of the outstanding shares of the company. Basically, it is the number we get when we multiply the number of the shares by the price, share price. In India, the listed companies have a market capitalization ranging from 5 lakh rupees to 21.4 lakh crore rupees. That is Reliance. So on Screener, we can, there is something called screen. You can click on this screener.in website and go to this home page. You have to register. And then if you go to these screens and click on this create a new screen. And in this window here, we have to type market capitalization more than 10,000. And click on run this query. You get a list of all the stocks. There are around 521 stocks in this list. So in one step, we reduce the number of stocks that we need to screen from 5,000 to 500. So among these stocks, we get all the good stocks in India. So next is the price chart. Here, we want to know whether the price of a particular stock is rising or not. For that, again, we need to click on the name of the stock and the details of the stock will come up. And here we should go to the price and click on 10 years. So it will show the price chart. Here the price is in a increasing trend. So basically the price 10 years ago should be less than the price now. Stock price will never go up in a straight line. There will always be ups and downs, but the overall trend should be up. Next parameter is the tax paid. Why do we select tax paid? That is because tax is one parameter which cannot be fudged by the company. So tax and dividends are paid only by the profit that is made by the company. So company can fudge any other financial parameter, but tax and dividends cannot be fudged. That's why we select this. Here you can see that the amount is on an increasing trend. Because the money flows out of the company, the sign is negative here. So we can ignore the sign and just look at the numbers. Similarly, dividend and this tax paid is available, can be seen in the cash flow tab. You have to click on the operating activity and there you will get the cash tax paid. And if you click on the financing activity, you will get the dividend paid details. The dividend paid also should be on an increasing trend. Ignore the negative sign. Next parameter is the sales. It is available under the profit and loss tab. Here it's annual sales that is represented here. Here you can see that the numbers are on an increasing trend. So select the companies which fulfill these criteria. From 500, you will reduce it to around 100. So now out of these 100 stocks, we need to select about 20. So how do we select these 20? Select some of the stock, divide these companies into various sectors. These sector details are also available on Screener website. So the companies, for example, we have companies from IT sector, pharma, banking, financials, consumer durables, and manufacturing, etc. There are so many sectors. So we can select 2 companies from 10 of these sectors and start investing. So when do we buy? Now that we have made a list and decided to invest, when do we buy? Best method is to buy in a systematic investment plan, that is SIP. So what is SIP? SIP is to buy number of shares, either fixed number of shares or shares for a fixed amount. at every fixed duration. You can decide whether you want to buy every month or every week or every day, whatever. So every month will be a better compromise. You can create a basket with the um, broker and execute that basket on the day on which you want to buy. Also, you can, there is another concept called dip buying. Dip buying is buying when the stock market falls by about 5 to 10%. How do you know stock market has fallen? Either you can track the Nifty or Sensex and keep looking at the chart every day, and or you can look at the headlines, newspaper headlines, like this headline where there is bloodbath on Dalal Street, or investors have lost 5 lakh crores. When such headlines come, that is when common investors will panic and they will look at liquidating their equity and entering fixed income. But we should enter equity. That is the best time. So one day or the other, all of us have to go up. So will Sensex and Nifty. So that is the truth. So when to sell? Before boarding the train, you have to decide your destination. So before buying a stock, you need to decide when you want to sell it. Long-term investing by definition is about 7 years or more. So you can keep a time target of 7 years. When you buy it today, you can decide to sell it after 7 years, or you can have a price target. For example, you want to decide to sell it when the price doubles. Maybe if the price doubles in 6 months, you can sell it at that time and enter another stock. And we have to review our portfolio annually. So this is very important, because out of the 20 stocks, 1 or 2 may go out of the criteria that we have chosen to buy them. So if they go out of the criteria, we have to remove them from our portfolio and add other stocks. So for that, we have to review the portfolio at least once a year. Also, in our portfolio, some of the stocks may not perform well. So we cannot expect that all the 20 stocks will be profitable at the end of 7 years. So 1 or 2 stocks may not make money, whereas about 4 or 5 stocks will give you lot of profit, maybe 300%, 400% profit will be there. Other stocks will give you average profit. So overall, at the end of 7 years, you will be positive. Another thing to remember is, don't invest money you will need in the next 3 years in stock market. Whatever is required for the school fees or you are running your clinic should not be invested in the stock market. So how much return to expect? Average Nifty return over the past 10 years is around 13%. So this return is basically the GDP growth plus inflation rate. That is how it is usually works out. So we should, when you are directly investing in stocks, we should expect to outperform Nifty. That is generate returns slightly more than that. So average expectation can be about 15 to 18%, which is much more than your fixed deposits can give. And as I told earlier, it is the portfolio level returns that is important. So thank you for listening to me patiently. Thank you for the opportunity. Yes, sir. Yeah. 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 See, when you apply a criteria, the idea is to eliminate those stocks which may not be good, like which may not perform. And it doesn't mean that the stocks which are eliminated are not good. Yes. No, not like that. Not necessarily. See, 500 stocks are about 10,000 crore market capitalization. Yes, market capitalization should be more than 10,000 crores. Because stocks which are low market capitalization may be manipulated. The price can be easily manipulated by market operators. No, Nifty 50 is the top 50 stocks in India. Nifty 100 is the top 100. Those are the large cap stocks. Okay. But more than 10,000 crores includes 521 stocks. So it is not necessarily only large cap. It will have some mid cap and some small cap also. Mid cap by definition is the 101 to 250th stock. Okay. So it will have 100 large cap stocks, 150 mid cap stocks, and another 250 small cap stocks. Yes. See, my top 2-3 holdings are HDFC Bank, Reliance, Tata Power, then Tata Motor, Tata Steel is also there. These are my top holdings. Yeah, thank you. Yeah, that is important. You have to do your own research. And correct. 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 It's actually learning stock market, learning to enter stock market and investing stock market is a long process. It will take time. 6 months to 1 year minimum time we have to spend. Yes, that Dr. Arun will talk about that next, coming up next. And regarding sharing the list and all, it is always better to do own research because then your conviction will be better. You will believe that what you have searched is good rather than taking tips from somebody and investing. Yes. Not necessarily, because my exit point may be different. Okay, you won't know when I am going to exit that stock. Not necessarily. I might have bought it 4 years ago. Yes. Correct. And also I told you that you have to review your portfolio.
Companies can change because tomorrow if something happened to HDFC, it goes down, he will definitely exit. He will not hold it for 7 years.
Yes, you have to review your portfolio at least annually.
So after this talk from Dr. Mahesh, which is definitely technical and for beginners, I know it is very intimidating, but it's not difficult because this MPTDS is a most simplified criteria because otherwise all the fund managers use a lot of ratios, all these things, and if you see that, it will be very scary. I'll be going to something more basic so that whatever you can start doing from tomorrow, instead of doing all this research, everything, you can just start blindly investing right from tomorrow morning. How many of you don't have a Demat account here? Anybody who doesn't have a Demat account? No. Tomorrow morning you are going to open it. Tomorrow morning. No. You should have a Demat account. In fact, every family member should have a Demat account. So I'm not a SEBI certified financial advisor. I'm a pediatric ophthalmologist. So this, I like to start my talk with this beautiful quote from Warren Buffett, which you have definitely heard many times. If you don't find a way to make money while you sleep, you will work until you die. So this is a very, very powerful statement. So we are all looking at achieving financial independence. So what is financial independence? Anybody? Can you just tell me what is your opinion? Exactly, yes. Any other definitions? Okay. So basically, financial independence is when your passive earning means you are not earning from your clinic. Your passive earning for returns from your real estate rents, FD interest, or any mutual funds. So your passive earning should be able to make good all your expenses, annual expenses, whatever your daily day-to-day expenses are there. Even if some COVID or something happens and you are not bothered about things because you are going to get your money anyway. So you are not worried about your clinic. So that is when you go for financial independence. That is the 6th stage in financial freedom. And of course, the 7th stage is abundant wealth. So previously we used to say whatever you save after all your expenses, you put it for investment. But now the new formula is whatever savings you have to do, you do that one first. So pay yourself first. So I'll show you the budgeting rule. So first you remove your savings, and only what is left after your savings you have to plan your expenditure. So that way the financial burdens will be less. So this is the budgeting. So before investing, first you have to budget. You know how much you're earning, and you need to budget it. 50% of your earnings, suppose you're earning 1 lakh in a month, 50% of that you can spend on your day-to-day requirements, including the EMI, education, groceries, or those things. 30% for wants. Wants means it's not absolutely necessary, but yeah, you want to do this, you want to do that. So for your wants, you can keep 30%. But 20% of your earnings, suppose if you're earning 1 lakh, every month 20,000 should go for investments. And investing is not the same as saving. Saving is you're putting your money in FD, means your money is preserved. You're putting 1 lakh today. After 5 years, 1 lakh might have increased by 6% per year. But there is something called as inflation, so which eats up all whatever your FD gives you. So saving is not investing. Investing is putting your money in avenues which beat the inflation. So the most, this thing is the equity, where you beat the inflation. And I would request you all to read this book called Rich Dad Poor Dad. I will show you this thing also. So here, there he clearly talks about this, what is saving and what is investing. So assets which grow and beat the inflation, that's where you need to make your investments. So before going for investments, first thing is to have an emergency fund. So wherever we have seen during COVID, most of them didn't have any earnings. So at least 6 months of your expenses should be in safe avenues like fixed deposit, or where you can immediately withdraw that one. Step 2 is to have insurance. So without insurance, you don't need to do any investing, because insurance is a must, because your family is dependent on you, especially if you have children. Definitely you should have insurance. And 2 types of insurance are necessary. One is health insurance. So you know now, of course, when we have normal power problems, our colleagues will help us with free consultations. But then when you really need admission in a corporate hospital, you know the bills, how huge the bills are coming now. So health insurance is compulsory. Every one of you should have a good amount of health insurance. And second thing is a term insurance. So most of us will be duped by our patients or our friends and relatives to take these ULIP policies. So endowment policies, ULIP policies, Jivan Anand, Divan Akshay, so many things they will start selling you. And you'll end up buying these policies, and they are the worst form of investment, because they don't even give what the FD gives you. FD gives you a better investment than ULIPs and endowment policies. So you always have to buy a term insurance, and the amount should be at least 20 times of your annual expenses, plus if you have any loan. And insurance should be till the age of 70 years. So many of the insurance, because when I was when I took my first LIC policy, the person has given me a policy till 100 years. So what will I do at the 100th year getting a money? Because insurance is only for your family in case sudden demise, so that they can secure their future. So there is no point in getting it at 85 or 90 years of age. So insurance should be only up to the age of 70 years. Premium payment till the end of the policy. There are many policies you pay for 10 years and you will be insured till 100 years. So that again not necessary. And buy from top companies like LIC, HDFC, SBI, because when you are 70 and the company itself has dissolved, there is no point in having that insurance. And the next important step is to clear your debts. So you should be EMI free. That is the most important. So only when you're EMI free, you think about investing, because you don't need to take a loan and then invest it to get money. So most important, clear all your debts. So if you're debt free, you can have a good sleep. So next is the planning for the next foreseeable future, like next 1 to 3 years. If you need any funds, so you want to buy some equipment or your child's education or marriage or some, you definitely know that you will need this in the next 1 to 3 years. Again, you should not invest it in assets like equity. It should be in fixed assets like the FDs or RBI bonds, debt mutual funds or liquid funds. So these things you can withdraw whenever you want. And the next step, after you have cleared all these 4 steps, you have had an emergency fund, you have took the policy, you have cleared your debts, and then you have planned your short-term requirements, whatever is there. Only whatever is left after that, you need to put into investments for long-term. And whenever you plan for investment more than 3 to 5 years, equity is the only way you can make good money and beat the inflation consistently. So coming to the equity investment, you can just see this video. Of course, there's no advertisement for this thing. I just got the video, so I'm just showing, shared by Dr. Ramurthy, actually. So 1 lakh invested in 1995 has become 10 lakhs in 2005. And from 10 lakhs in 2005 has become 50 lakhs in 2011. And 50 has gone to 1 crore in 2018. And from 2018, 1 crore has gone to 2 crores in 21. And 2 crore in 21 has gone to 3 crore in 23. So this is the power of compounding, and this is the power of investing in equities. And by 2014, so this 1 lakh what you have invested there has become 4 crores now. No other investment, including your real estate or wherever, you'd have got this amount of returns. So when you come to investing in equity, either you can do invest directly into stocks, as Dr. Mahesh has detailedly told you. Of course, this is the best method going forward. All of you should invest in direct stocks. That is the way you can earn the maximum profits. But then it's difficult for many of us to start directly investing into stocks because we don't understand the companies and all these MPTDS criteria and all those things. So what you can do is you can start with mutual funds, equity mutual funds. These are the easiest way to start your equity investing. And even more easier than the mutual funds, as Doctor said, is to invest in the index funds. So this Nifty is an index. I think all of you should have heard about Nifty and Sensex. So Nifty and Sensex is an index. So index means Nifty consists of the weightage of all the top 50 companies in our countries, like the Reliance, Infosys, HDFC, TCS. So all the top 50 companies by market capitalization. They are taken, and they have some calculations for that to arrive at this index. So Nifty comprises of the top 50 companies. So if you are investing in Nifty, naturally you are investing in the top 50 companies in the country. So the risk of losing is very, very zero, because Nifty will not become zero. Because if some company in the top 50 becomes zero, naturally that will be eliminated, because every 6 months it is rebalanced. So if some company, like the best example is Reliance Communication. At one time it was a very top company. The shares were trading at 900 odd. And now it has become to just a single digit this thing. So that company, suppose if you had invested in Reliance Communication, you would have lost your entire money. And Yes Bank is another example, which is trading at very high levels, and it had dropped to 10 rupees. So if you had invested in those companies, you would have directly lost money. Whereas if you are putting your investment in Nifty, Nifty automatically eliminates that company. Next time in the 6 months when there is a rebalancing, automatically that company is eliminated. So you are automatically, the risk of becoming zero is nil, because Nifty will not become zero. The companies keeps changing every 6 months, and your investment is safe. And it's a blindfold strategy. You don't need any analysis. You don't need to go through the screener, as Dr. Mahesh has said. You don't have to do any analysis. You can just blindly, from tomorrow morning, you can just go and do a SIP in Nifty Bs. And invest, the best, as Dr. Mahesh has told, best method is to do a SIP, systematic investment plan, because we don't know. See, just on Friday, there is a 2% correction in the Nifty. It has fallen by 2%. So you cannot time the market. So always it is best to do a SIP every month, first or every month 15th. You just, whatever the 20% of your investment is there, just put it into Nifty Bs. So advantage again, it's compared to other mutual fund, it is a low expense ratio. Average return from Nifty 50 stocks is about 12 to 14% in the past. And according to a survey, 90% of the mutual funds, whatever the mutual funds I am discussing, they don't beat the index because they have something called an expense ratio, because the fund manager has to take his salary and all the expenses what they incur. So they deduct about 2 to 2.5% of that this thing as an expense ratio. So naturally they cannot beat the index. So Nifty, investing directly into Nifty index is definitely more easier, and you don't need to do much research to invest in this. And also there are a lot of malpractices from fund managers. So the Axis fund, there was a problem, and this thing came down. The NAV of that Axis fund came down. And recently there is this thing going about Quant mutual fund also. Quant has given extraordinary results in the last 3 years. And so they are investigating into that also now. So that risk again is not there if you invest in the index fund. So how to invest in index? There are, as I said, you can either do something called the index mutual funds or exchange traded fund. So my preference is an exchange traded fund because it is easy and you can do it through a demat account. And also this thing is the prices are tracked every moment, as every day whatever the prices are changing, it's changing. Whereas in mutual funds, the NAV is decided at the end of the day. So for investing in Nifty ETF, that is a Nifty Bs, that is my favorite, you have to have a demat account. You cannot invest in a Nifty B without a demat account. And as Dr. Mahesh has said, the SIP is the best method of investing. So as Dr. Mahesh had told, there are 3 categories of stocks. One is the large cap stocks, which is the top 100 companies in the country. Typically, investing in large cap stocks will give you 12 to 15% returns annually over a period of 10 years. Mid cap stocks, next 101 to 250 stocks. That gives a little, because these are smaller companies, so the possible this thing is more, the generation of income is more here. So that gives typically 15 to 18% of the returns. And there are some small cap companies, which are smaller companies, that is beyond 250. They give higher returns. But at the same time, the risk also is higher, because the small cap companies, many of them, the proprietor may run away, or there may be fraud. You have heard of Paytm and Zomato. So all these companies, sometimes the promoter might commit a fraud, and the risk of these companies becoming zero is also very high. So risk is high, return is also high. So that risk is always proportional to the return. So if you want to invest in large cap ETFs, the best method and the simplest method is the Nifty Bs. So Nifty Bs is from the Nippon Mutual Fund. So this is the simplest method. You just put from tomorrow morning, you just put a SIP. You just open an account in Zerodha or ICICI, whichever is your preferred banker. You just start putting Nifty Bs. Don't time the market. Every month, 15th or whenever your funds are available in your bank account, you just start putting a SIP into Nifty Bs. If you want to take little more risk, because the Nifty Bs contains of the top 50 companies, 0 to 50. If you want to take little more risk in the large cap itself, there is something called as a junior Bs, which is a Nifty Next 50. So 50 to 100. So those companies. And if you want to take even more risk, then you can go for the mid cap ETF. And in mid cap ETF, again from Nippon, we have something called as a mid cap 150 Bs. So again, this is a very good option to invest if you want to take little more risk. And if you want to take more risk into small cap companies, there is something called as HDFC SML 250. This is again an ETF which you can buy from your demat account. So these are the simplest ways to start your investment. And what I would suggest is, if you don't want to take any risk, you directly go only into this the Nifty Bs. Nifty Bs is the least risky. You will never lose your money with Nifty Bs. You will always get profit, but profit will be around 12 to 14%. Whereas if you are able to, especially for younger people, if you are able to take little more risk because your horizon of investment is longer, I would suggest that you take a mix of these 50% in Nifty Bs and Junior Bs, 30% of your this thing, suppose if you're investing 1 lakh, 50,000 in large caps, that is Nifty Bs and Junior Bs, 30,000 in mid caps, that is mid 150 Bs, and 20% in small cap, that is HDFC SML 250 ETF. So this is a very good mix for especially younger people. You will, in the long run, you will definitely see the benefits of it. And after 10 years, you will let me know what is your returns. No, tell me. I don't know. I'll be speaking after 10 years. And if you want to invest in mutual funds, there are two very good places where you can get information. One is the valueresearchonline.com. Excellent website. It gives all the details of all the mutual funds, where they are investing. So Dr. Arun Adkoli was telling, you just see the stocks where mutual funds are invested. So if you just go to valueresearchonline.com and see those mutual funds, they will give you the portfolio of each mutual fund. So if that Nippon equity fund is there, what are all the stocks which that fund has invested? The whole details will be there. Comparison with the peers, everything is there. Excellent website. You all should visit this website once. Please subscribe to this magazine, ET Wealth. It comes on every Monday. Every Monday it is released. It's all hardly about 8 rupees. Wonderful magazine. It gives a lot of information about your financial planning, and articles are really, really good. This is how this value research online, this thing that comes. I don't want to go into the details and confuse you more, because today I want to restrict it to the index funds. And if you want to invest in mutual funds, always go for a direct fund. There is something called as a direct plan and a regular plan. Most of the agents or your friends or relatives who would have, if you have forced you to invest in mutual funds, they would have always done it with the regular plan, because they get at least 1 to 1.5% commission of your entire portfolio. Suppose if you have invested 1 crore, every year, whether you get profit from your mutual fund or not, they will get 1 to 1.5 lakhs into their kitty. So that's why all these agents or brokers will always suggest the regular plan only. Whether if you go for the direct plan, that expense ratio will be less, by about 1 to 1.5% less than the regular plan. So always go for the direct plans. So if a doctor refers a patient for an MRI or a lab and then takes a commission, it is illegal. But whereas here it is 100% legal, and they are openly taking the commissions. So this is the difference. Suppose you invest in a direct plan and regular plan. 10 lakh investment over a period of 20 years, almost you'll be losing about 18.76 lakhs. That is about 19.5% difference between the direct and regular plan over a long period of time. So where to buy? I would definitely recommend Zerodha, because it's the most popular now. I am having my account with Zerodha, and it's very simple. You can open it online. You don't have to go anywhere. You can sit in your house, in the comfort of your house. You can open the account today itself and start investing from tomorrow. And these are the other places where you can get direct plans. Coming to the taxation, which also we should be very familiar, because taxation on equity is much less compared to our professional gains, business income. So if you hold this thing Nifty Bs for more than 12 months, the capital gains is only 10%, and that too after a deduction of 1 lakh. Every financial year, 1 lakh is exempted from tax. So 1 lakh is tax free. And beyond 1 lakh, whatever capital gains you have, it is taxed at only 10%. Whereas most of us are paying 30% on our gains from the professional listing. So taxation wise also, investing equity is definitely worthwhile. So before jumping into equity, just remember, as Dr. Mahesh has also emphasized, equity is a long-term investment. Put only money you don't need it for the next 5 to 10 years. Don't take a loan and invest your money. Clear your debts. That is most important. Be EMI free. That is the first thing before investing. You should be able to sustain the bear markets, because many times you will see, especially during COVID, you saw that the market had dropped down from 11,500 to 7,500. There was a huge drop, and that was a huge opportunity, and that's when I started actually investing. And my portfolio has actually doubled from there. And don't sell in bear market. So whenever there is a crash, actually June 4th, election results day, when the counting was going on, the Nifty dropped by almost 2,000 points. That was a huge opportunity actually to buy. So don't sell, because there are a lot of people who are selling, at that time, So don't sell when there is a drop or sudden this thing, and that is an opportunity to buy more. And in MF, always opt for the direct and growth plans and open-ended funds, and don't have too many funds in your portfolio. So is direct equity for me? Yes, definitely all of us should, our aim should be to transform from these ETFs to direct equity. Direct equity definitely gives much higher returns depending on your knowledge and how much time you can spend on that. But it requires definitely more time and attention. And I would request all of you to spend at least 1 hour in a day to, 1 hour in a week to gain some knowledge about financial markets. So take home points, make your money work for you, have your passive income so that it can take care of your annual expenses, and you should be financially independent. Equity is the best method of compounding wealth in the long run. If you don't have any knowledge about stocks and mutual funds, best is to start investing in Nifty Bs. Absolutely safe, and you don't have to really worry about losing money here. No age is too late to start learning. I started at the age of 50. And please read this book at least 10 times. The wonderful, wonderful book. You will totally change your attitude towards finance and managing your money. Please buy this book and start reading that. Thank you. Any questions?
Any questions? Okay, Dr. Arun gave us the thought process behind the kind of why investing and the difference between trading, investing, etc. And Dr. Mahesh and Dr. Arun Samprate have given the tools of investment basically. And now Dr. Gagan is going to talk about the way to do it actually. I mean, what is the process? He's going to give a roadmap. So by the time he sets it up, if there are any questions, probably we can take.
Definitely, madam. Yes. If you have regular mutual funds, you have to change it to direct, but you cannot change it directly to direct. You have to withdraw that one, redeem that one, and then you have to start again fresh investment. So that will also incur capital gains for this financial year, but it is still worth.
For a long time, saying we follow the facts now will offset, the subsequent saving that you do actually. So you will not be able to transfer, you cannot take away the agent. You have to close that account and immediately open a new account because the market will be at the same rate now. So whatever the NAV that you sell and probably buy, there won't be any potential loss. But what you are actually lose is the capital gains, that 10% tax that you are going to
I have caller mic. Thanks. Okay, good evening. Thanks for staying. I believe it's a big onus on us to make it worth your time. I'll try to do so. My speakers have already proven their worth. Okay, so quick questions to wake you from slumber. How many of you are motivated to do anything which has been discussed till now? Show of hands, please. Oh, 90%, sir. Distinction. Okay, so next, how many of us do online shopping? Amazon, Flipkart, Myntra for women, at least lots of courier come to my home. How many of you use some kind of Google Pay, Phone Pay, everything? How many of you operate your bank on your mobile, the banking apps? So basically, that's more than enough. I don't need to present, that's all. If you can do that, you can do all these things. So then one slide is all what it is for an audience of this IQ. Okay, so to do whatever has been discussed, logically you need three things. One, you need money, means a bank account. So there'll be one dedicated bank account from which the money will come and go. Your profits go and money comes in. Then you need a trading account. Trading account is a broker, because brokers are the one who are intermediary between you and the exchange, right? It could be any broker. And all the shares which you buy and sell, ETF which you buy and sell, they need to go into some account. Like our bank account has money, your share account is called a demat account. Demat because they are electronic, they are in a dematerialized format. Earlier you had physical shares. Like FD used to get physical share, now it comes into account. So shares were physical, now they go into account. So that's a demat account. So you need these three. If you get all three together, it's a 3-in-1 account that you will get with banks. So your HDFC Bank, ICICI Bank, Kotak Bank, whatever, they come to you, they give a 3-in-1 account, which has all three components. All other, when we are talking about a trading account, demat account, earlier you could have all three from different. Now it is not possible. Either you take all three, or your trading account and your demat account will be with one broker. Now with demat, you get two companies which give you demat. CDSL, NSDL. Take CDSL. We don't take NSDL account. There are issues with transferring shares, selling, and closing. So any CDSL account works fine. And most of the brokers, what we are discussing are all CDSL, right? So again, account opening, offline, long process, need to pay a bit more for it. Online easy. You go today evening, it will be operational by tomorrow, day after. All of us open online, we close online. Many brokers are very clever. They allow you to open online, you can't close online. Closing is a pain. Emails, this, and every time you try to close, 2 rupees is pending, 1 rupee is pending, you're practicing. Then again pay. Now you have paid more money, extra money is there, we can't. Horrible, they will not close their account. Okay. And brokers are classified, if you see, as full service brokers, discount broker, and free brokers. I'll cover that in the second last slide. What are your requirements? There's a title. And for people of IQ who are in this room, this is what is required. Okay. To open any account, whether online or all, this is what required. So you need to have your mobile number, which is linked to your Aadhaar, right? For your eKYC, for everything, mutual fund and all, you could do online KYC. So online KYC, the important thing is mobile number to get OTP. Your account can have a separate number. So you should have the mobile number which will get OTP with your Aadhaar. You need to have your PAN card, and PAN card name and Aadhaar name should be same. And then you need to have your bank account with online access, net banking enabled. That should have the same name. Any name mismatch, you cannot open online account. You can't get OTP, you can't open an online account. Okay, so these are mandatory requirements. Now, for other proof, you need to have a cancel check to upload, okay? And nomination is mandatory now, so sometimes you have to do immediately, sometimes you can do it later. This is required. Other thing which is important here is, I want to trade in my wife's account, just to save tax. I want to trade in my brother's account, my son's account, my parents' account, whatever it is. In that case, what you can do is, the email and phone number for account, the address for communication is yours. All other numbers are belonging to that person. So I can very well use my wife's account on my phone with all the intimations onto my phone and email, but bank account and all the information will be hers. So the OTP for bank transaction will go onto her mobile. Everything else I can operate, right? And most of us do it on mobile. That's what I've seen. We are not IT people having laptop in the time. They do it on laptop. So with mobile, apps are important. So any broker which has got a decent app is good for us. And to have 2 apps with same, like if I open an account in Zerodha, everyone has been discussing. If my wife has in Zerodha, I can't use 2 apps on my mobile. Samsung, you can do clone app and all. I don't want clone app, financial issues. And Samsung has a provision for 2, but other phones don't. Tomorrow if I go to iPhone, no. So in that case, you can have 2 account in 2 different brokers. So my account is in Zerodha, my wife's account is in Angel One. So I can use both, and on her phone as well as my phone, right? So that's the only thing which I can add. Other things are all there. And this is a process with everything. Wherever you will go to open an account, they'll start with your phone number, OTP, email, OTP, then fill in your name, address, everything. Then Aadhaar number, it will capture everything. The address comes from Aadhaar. Upload your bank accounts, give a cancel check. And there is a video KYC for every account opening now. So though everything you can do, but the person with whom you are opening the account needs to record that video KYC message for a 30 seconds, 20 seconds, whatever. So their presence is necessary. Video KYC is also easy with mobile because cameras are very easy. Laptop also it can be done. So you can open your account with this much. I think so that covers the topic, but I'll give you something more for your time now because this one slide will make nothing much. This is an additional requirement. If you are going beyond what has been discussed, if you want to go for FNO, so currently it will change in this budget, that's what its newspapers say, but currently for FNO you need to upload any one of these documents as an income proof. Okay. If you don't want FNO, if you don't opt for FNO segment, when you're opening your account, important, it will ask you want account for what. So you'll choose equity, NSE, equity BSC, you'll choose mutual fund options, whatever come. You will not choose derivatives, you will not choose commodity. Choose them only if you want to do. Otherwise, leave them off. They will not be activated for you. You can activate it later. Okay. So what happened? Okay. Account typically 1 to 3 days. Many brokers are quick. It has even earliest I've seen it get activated in 6 to 8 hours also. But 2 to 3 days, let's assume. And download the app for that broker and website and familiarize with what is where. Because until there is no thing, it's like you calling, I'm stuck, we tell you check for this, like it's easy. Because you know what is pulse, what is BP. But if you don't know pulse, if someone check for pulse, what is pulse, right? So just before you actually do something, spend that time on website and app, see where things are. It's all same, it's just like all our FACO machines. Some parameter is left, some is right, some is up, some button is down. It's all just jumbled up, that's all. Everything has a similar functionality. And most important, a broker which I like is where you get clear-cut reports for tax filing. Because some brokers, you really can't figure out what has happened. Have you made a profit? Have you made a loss? Whatever. The back-end function of reporting is horrible. Right? So then you are ending up either paying less or more. God knows what is there. And when we can't understand what government is understanding from those accounts, I really don't know. So even auditor has said that, these brokers, we are having problem, please change. Right? So that's another thing. And figure out where the report comes. So once you do your first transaction, try to get where the reporting things are, because you need to file your taxes. If you're not getting that, leave that broker. And if it's your existing broker, please check today and then change. Okay. So this is where you go. So once you open an account, this is Zerodha. Everything is the same. So this is what you call a watch list. Watch list is basically the stocks which you have added here. So this is something called a watch list. So it is 1, 2, 3, 4, 5. You have different watch lists. Zerodha gives it down, Dhan gives it up. Somewhere you will have something like this, which is a watch list. Here you can add stocks to, sorry. Yeah, that was for audience, because I knew you were going to talk about that. So it's like a cataract session, and everyone going to sing. So I was about to say that, see, this is what everyone is saying. Okay, so this is a watch list. How you add to watch list is on top this search bar you see, this one, this search bar. You just type the name of company. So I'm typing Reliance there. Reliance will come in a drop down. You see that green plus button which says add now? Press on that green button, it will get added, and then Reliance is added below. Right. So you can add like this, make your watch list. Now in your watch list, you keep tracking, or you can buy from watch list. I always prefer buying from watch list, even though if you see, once you put the name, no, it says B and S. B is buy, S is sell, that red and green. So buy is sell is always red, buy is either blue or green in most of the brokers. Again, same. So something like that, you make your watch list. And now when you will click on this watch list, something that buy and sell, so I've clicked buy. So this kind of a window opens. Here, it is say quick, regular, AMO, iceberg. Our orders are regular. AMO is which you place in advance, right? So what you have to see is it should be regular. And intraday, what you see above this number 1. You have another one here. This is really not working on the. No, if you have a stronger one that works. This one will work. Thank you. So above this one, can you see intraday and long term? MIS, CNC. Never change intraday. Intraday automatically, end of the day, they will cancel your order. So if you have bought something, it will be sold. So since you are investing, make sure that you don't buy this. In case you buy that, you can always change. But always and always make sure this is long term. And market order means it will get executed at whatever price is prevailing then. It's a blind order. If you want, and like if you have seen watch list 273.29, or here 31130, you put 311.3. So then it will get executed at this price or lower. It will not get executed above this price. So this is limit. So select market or limit. And here if you see, you will get the total amount which you are spending. So if I buy 10, it will show 31,100 something, right? So whatever buying, how much total investment. And this is interesting. This charges is coming, no? Click on this, you will get the charges details. So you can also calculate for buy and sell how much you are spending. This includes the taxes and brokerage and GST and all that shit what we give. So there are some 8-10 taxes which apply on all this thing. And expect 2 more after 2 days. Okay. So this is selling same. You go there, press the sell button. I'm selling 1. And here if you see, these are the charges same. So regular, long term same, you sell. Okay. So this is the buy and sell. Just go into press and just look at these figures in your broker, how they are. Don't worry about iceberg, AMO, cover. This is all later, probably after 2-3 years when you go into the next level of this course and when viewers conduct next level of this. Okay. So any doubts over here? Because then we proceed to the final slide. So this is clear till here. Any doubts, anything? Yes, madam, please. Madam, you have to always go through broker. Okay, mutual funds have 2 plans. Madam, I'll answer it in a different way. Your stocks or equity traded fund, the exchange traded fund, they are on exchange. Exchange means stock exchange. So here there are 2, NSE, BSE. Any exchange will not give you, through exchange and a customer, there is a broker. So even if the mutual funds want to do, they will either go through an intermediary or they will take a broking license. So there's always a broker. It's just like when we want to trade with HDFC Bank, we have a bank branch here. No, we go to that branch, though we are trading it, let's say Mumbai head office or with RBI bonds or whatever. So if you want to invest in any of the government schemes, government bonds, you again go through some intermediary. So broker is your intermediary. So that's the way we can explain it to you. So Order. It's a order type, madam. Anyways, we can answer it out again also. You, even after this or anytime, give a call. We'll tell you. And it's very valid question, madam. It's like our, I'll bring one term. If you are accredited hospital, there is something called recall process. And recall in NABH is ulta than end of cell matrix recall. In all eye hospital, the answer is always wrong. In any general hospital, the answer is always right. Because recall is meaning different things to different people. Yes. So mutual funds are three types now. One is you go and buy a mutual fund through agent, through your bank or whatever. They give you a regular plan. No. Coin is the name of mutual fund platform of Zerodha. So if you want to buy a fund through Zerodha, it will open up a coin window. You can, 1 minute, I'll come to that. So regular mutual fund you can buy through anyone. Your brokers, your banks, whatever calls you get and all those things. In direct mutual fund, regular mutual fund, the person who's selling you that plan gets a commission. If you take that same plan directly from the mutual fund company, through their website, to Mutual Fund Central, or through something like Coin, then you don't pay that commission, which sir told 1 to 1.5%, which the broker is eating away, or the middleman is eating away. ETF is exchange trading fund. That you can buy and sell only on exchange. And for that, you need a broker and a demat. ETF is exchange trading fund. There is no broker, there is no regular, nothing. It is traded on the exchange. It's like a stock. So company has made a mutual fund. Nippon makes a mutual fund, but it is traded. So it is real time. Whereas mutual fund, you get a NAV at end of the day. Here, these prices change real time. Yes. You can buy low. Mutual fund, you cannot ever fix your buying and selling price. Here, you can buy at your choice price. Okay, madam, short term for everyone is different. Answer was given. So if you want a specific question, define what you mean by short term. What is the time frame you're talking? Okay. Anything which is kind of fixed or later.
Just last year, the index was 21,000, now it is 24,000, and correction is due. So we don't know what factor will trigger it. We just need a reason for the correction. So some silly reason can trigger a correction and it may again come back to 21%. So anything you need in the next 3 years, please don't invest.
Yeah. FD rates are high. They are expected to come down. Find the highest FD rate and lock your money. Yes. If you understand this, yes. Yes. So it depends what fund you have. Then it becomes very individualistic. Some funds will not be replaced by ETF. Some funds you can replace by ETF. No, sir. You are putting your money in how many mutual fund? Number just 5? 6. Out of 6, all of them may not get converted to ETF. Maybe 2 or 3 can be replaced by ETF too. So there may not be a comparable ETF available to your mutual fund. Nippon's index, oh, Nifty is there, no? So it's 1,000 of Nifty. So let's say Nifty is 20,000. So divided by 1,000, you get 200. So the ETF, Nippon ETF of Nifty is 200. Nifty becomes 21,000, it will become 210. Yeah, large cap ETF is the Nifty Beast, what sir told. That is Nifty Beast is a large cap ETF. Navi is same as Nifty Beast. It's a different company. Nifty Beast, all Beast, BES, all Bees are Nippon. And why everyone talks about Bees? Because they were the first one to launch. They have a big track record. They have low expense ratio and the more reliable name. Navi is new one. So it is again an ETF.
So liquidity is high. Like suppose if you want to sell tomorrow, you can easily sell a Nifty B compared to the Navi.
Yeah. Everyone take a photo of this. I'll tell you why. Okay. So this link, sir, we'll take your question after 2 minutes. I'll finish. Okay. This link is an Excel sheet which I was making for this talk, and putting it on slide was little too much. So I've done some comparison of broker. You can use this link or use this scan and you'll get that Excel sheet. So that is probably homework for today evening. You can compare and actually do your analysis. Okay. So full service broker, which is typically your banks or the bigger brokers, I would not recommend. Lots of charges, lots of hidden charges, lots of changes. I have my Demat account in HDFC from 2003. I have not used it for last 4-5 years. Okay. I first invested in stock when I finished my 10th, and I was waiting for my medical cyst after 12th. So that was 1994. Okay. Yeah, 1994 I started. Okay. So bank brokers, if you have, continue, but think over of switching. I'm not saying close them. Stop. We always stop and go to something which is better. And way things are changing, like in ophthalmology also, equipment scene, how it is changing. One is buying the other, same thing. What we are discussing today, maybe in the next session, we'll be talking something different. So we have to be also agile and accept that change now, that wherever we are, like sir told, first step, stop. Then we reevaluate and start afresh again, and then we'll see what we have to do for the old. So be ready to stop and take things again. So discount brokers are the popular one. Zerodha, Angel One, Dhan. I would say these three. Grow, personally, I have issues with that, and there are lots of issues with the platform, though it is the largest platform now. It has overtaken everyone on back of the massive advertisement. Grow is the largest discount broker in India. Zerodha is number 2. Angel One is a public listed company, good. So Zerodha, Angel One are virtually the same. Somewhere Angel One charges a little higher. If you have a Zerodha account like mine, I have Zerodha, I don't want second Zerodha, I would take Angel One for my wife. Zerodha was glitch free. You had one glitch in 2 years, but now Zerodha is same. Zerodha was not working on the election day. Last 2 months, Zerodha has been down for 4 times. Angel One was not working on Friday when this whole Cloudflare thing happened. So brokers are not working. Anyone who's actively into trading or someone, you may have to have 2 brokers. Sometimes you bail out of some positions you have. But for investing doesn't really matter. But I would say any of these 3, Dhan has got some unique things. It has got very good trading view charts. Otherwise, trading view platform, if you go into charting and all what sir told, then you have to pay. But Dhan has the only broker in India which is integrated with trading view. Okay. And for females, Dhan is cheaper. So it is 50% as of now compared to Zerodha and this one. So female account, Dhan is good, has everything. And Dhan also has a different app. So you can call a basic app and there's an advanced app, same on website. So someone who wants more options, Dhan will be good. And it's not public listed. So these 3, as of today, would be my choice to open an account. What I have Zerodha and Dhan. What my wife has is Angel One, right? This is our hidden charges, sir. And IIFL gives lots of commission to the person who has opened your account. If you take IIFL account through my referral, I get 75%. Someone is there in middle, sir. 75% IIFL gives. Very bad. And they have multiple apps and hidden charges. You will have to check every time where they are charging you more. They are skimming people. I had IIFL, I have used it. Looks good, but is not good.
So you can exit from IIFL now?
Sir, wherever you stop, you take this and you sell those whatever holdings are there. That's okay. Why do you want? No, not sell. Stop your IIFL, move to a better broker. Once you are satisfied, comfortable with the new broker, you can start your dealings. Then you take a call on what to do with that IIFL. No, sir, it's easy. I'm sorry. CDSL, no. In CDSL, you can move your account from one CDSL account to other in one shot. IIFL, CDSL. So IIFL, he can move his account to Zerodha, Angel One, Dhan. But he needs to familiarize with this platform, no. See, tomorrow he opens and he's stuck. So use this something for a while and then move. Yeah. See, you get a new.
But you will not get to know what of the hidden charges, what you are doing.
You have to check your contract notes. So that's the thing, we're not. So the one part is if you really want to analyze a broker, either we have done that, or you want to do you collect contract note of different broker and see how they're reporting. So I have done this exercise and I'm sharing it with you. So I have had IIFL account, I have closed it. Okay. I have tried many brokers as my backup broker had closed. So that's why IIFL is not in that list. But if you say they are going to cheat you or no, actually one important thing. Your money with broker up to 25 lakh is insured. Like FD is 5 lakhs, no? Broker is 25 lakhs. So most of the people, if you are doing high volume, you would not like to put lots of money in one account. So 25, 13, one, 25, 13, next, something like that. What shares you have in your DMAT, their broker will not be able to touch. They are fully secure. Shares in DMAT, not an issue. The cash which is in broker or in transition or buying and selling, 25 lakhs is the limit. Beyond that, you will lose money. Okay. No, sir, they charge. That Excel sheet, if you open, you will get the schedule of charges. They don't charge for equity delivery, like buying of equity and selling of equity is free. Others, they are charging. They are discount. They are cheaper than the full service broker. I'm coming, sir. my last line, and then I say thank you and open to discussion. Okay. These free brokers like Flatrate and MProfit, they don't charge any brokerage. Typically, they don't charge for commodity and FNO. So somewhere you are dabbling in there and someone who is doing a little more trading, you save brokerage costs there, but they are not as good, are not as feature rich, and it's just like an old scooter and old FECO machine, you have to struggle. But if you want a totally free broker, MProfit is by Mirae, the mutual fund house. They are becoming aggressive. They have bought Sher Khan. They are coming into big scene. So they charge you 2,000 rupees flat for lifetime free account, free demat, no charges. Here demat charges are there. Every year you pay AMC charges, which are 300 for Zerodha. So every 3 months you pay 75 rupees for a demat account. Dhan is free demat. These are free demat. So if you open an account and don't do anything, you don't pay anything. They are good for testing waters also, trying to learn. But you will find that these apps are not good. The websites are not good. Many things are lacking in this. These are only and only if you need a free broker, you want to just try, maybe you want to initiate. But typically, Flatrate is good if you go in for algo trading. They integrate well with algo. So for algo, whatever platforms and whatever vendors are available, you'll get algos for Zerodha and you'll get algos for Flatrate. So Flatrate is a one preferred choice for algo trading. So algo we are not doing so. But this in free broker, for some reason, if you want to choose, these are there. And charges, that Excel sheet again, I've given a comparison of charges over there. Okay. So, okay, I'll come to that. I'll say thank you first, then everyone can chip in, otherwise it's question to me. And I really hope it was worth your time. Last session, having this crowd, really hats off. I feel that, kudos to Dr. Bhargav who thought of this topic and has put. And I was telling him, you are vice president, your topic, this topic you're putting last. I'll give you, which one? Please open. Here. Slide before this, if you can leave it, there just one. So you can address your questions to everyone now, not only me. Arey sir, I am here, everyone. No, I shared that because that Excel sheet took me a while to put, so I thought I'll share it across.
Trading in FNO is a very, double-edged sword. It's tricky and double-edged sword. And
Mike. On mic. Take your questions.
That's the reason why government is trying to get some restrictions.
not recommend you to go to FNO without proper training.
Sir, anyone who
And
can
if
handle
you
equity should think
Want
in
to
terms
get
of
trained in
FNO.
FNO, there is a very good course called TMP from WealthCon. So you can join the WealthCon program. They will teach you in a systematic way how to do FNO.
Warren Buffett called FNO as the weapons of mass destruction.
Yeah. But
Who don't know.
no, FNO needs time. The problem is, if you are into full practice, we will not have time for FNO.
As Mahesh said, 90% of the people will put money into 10% of the people.
Yeah.
That's how it is.
But if you have time at hand and you are comfortable with equity, then FNO you can move. That's certain. Look, TMP, they say fresher is good. All of us can agree. Yeah, like if you are totally novice, I think so with TMP they can move. And I've seen people who were straight without us TMP and they've started. But I think so on your own and this YouTube and all, it's difficult. If you want FNO, some kind of, yeah.
And there's always something called beginner's luck. It will take you, and then.
Yeah. No, magazines, YouTube, everywhere, it's everywhere. Tuesday, I don't think so what's happened. It will be lots and lots again, FNO.
Any questions on equity and mutual funds?
Yes, sir.
Yes, sir. Mike?
Right.
Yes, sir.
But when it comes to purchase of shares, you say individually we have to learn and invest. Instead of that, 10 of you who have already learned, 10 of us who are yet to learn, can join together and give suggestions. You buy these, you sell these.
Sir, I'll tell you the
I'm just
reason.
telling that
Question is to me, I'll answer.
The errors will get sort of minimized. Like if
Okay.
I learn everything
Sir,
and put it somewhere, I'm
Sir,
into an error.
it's the conviction. So what happens, I can.
It's not scientific. It may be a conviction, but if 10 people, like all of you are knowledgeable, you have
Yes, sir.
such a a long, path already treaded in.
Yes, sir.
And these are youngsters who do not know. The chances of making a mistake from mistakes can happen in any hands. You will be doing lesser mistake than the
Please
people who are
call,
learning.
please come on Zoom, come once a week, more than happy to share. What else?
No, we all understand it comes with Islam. You suggest that you buy this, tomorrow I may lose all the money. With that conviction, if 50 people are willing, like BOS, 50 people are willing to put the money and withdraw it, either way.
What we are planning at this particular year, what we thought was we start running a very systematic every 1 day, every 2 months, either web-based or physical, physically initially and then physically we can
So I went through that Akash's 1
Akash
year,
Patel, yes.
but I'm not
No,
put
no,
one.
his course is not structured, sir. It's not.
Who's
like very
Akash?
structured.
Sorry,
Akash Patel
Akash
from
Patel.
Rajkot.
As per the SEBI circular, it's illegal to suggest any stock.
Yes.
A lot of illegal things happening unless we come,
So there are
unless
two.
we go and complain to SEBI. How will SEBI know what's
Actually. Yeah. Sir, I can suggest two solutions for this, sir. One is the best method is ETF. You don't have to do any analysis. Directly invest, blindly invest.
What is this?
You will not lose your money. You will definitely get good returns there. Second thing, if you want to invest in stock, you want to have a MPTDS stock, you join the WealthCon group. There is a Telegram channel, WealthCon. Join there. There already the stock list is there. MPTDS stock list is there. So that will be updated every year. They do research and the scholars will.
I'll
keep,
message you,
this
sir.
thing.
There is a WhatsApp group
So-
also of doctors who are there in that group. So that stock discussion takes place and even stock suggestions takes place. So there are groups in doctors group only which are there.
No, I know Arun, but those people we don't know. I can trust you, but I will not be able to trust them. That's the only issue. The other thing is, it's like I'm never into shares trade. Though I've come and listened.
Sir, what
here.
about the person standing behind you?
He may be. I don't know. It's his prerogative. I had some physical shares purchased by
Yes, sir.
father in my name.
Yes, sir.
So I had tough time to see what happened. I just kept it.
Sir, you
kept
have it
kept
now?
No.
Okay.
2-3 years ago, I gave to a company called BGSL.
Okay.
They did something and converted to them.
Done, sir.
And they are with BGSL. Then I don't know what to do with them.
No, you have to sell them, sir.
It's in my name.
Sir,
But then
so, so you can either take a call, we can either sell them and do something like this, or you can shift to another account.
anytime I need to buy, I'll have to call them up, send them.
No, sir, online, that's the advantage. That's why I said mobile apps and that was the thing.
BGSL, I'll have to shift in online.
They may have an online platform, sir. If you share the broker, I will check and get back to you. That I can do personally.
BGSL is the share.
I'll check, otherwise I'll call you. BGSL, I'm not aware. I'll check and tell you.
And is it possible to have accounts in both?
So you
that
can
is-
have, you can have,
That is in national.
sir, you can have in CDSL 10 accounts. I have personally 3 accounts.
Oh.
Okay. So I actually have 4 accounts. HDFC account, which is from 2003, which I don't use because there are some long-term SGBs and all I'm letting it mature. I have not used it for a while. I have a Zerodha account, which was my second account after HDFC. Then I have a Flatrate account because I was dabbling into algos and doing certain things and coding and all that shit. And then I have a Dhan account, which is my backup account because I have separated something. So what happens is, like, I have a TMP portfolio, that's with Zerodha. I have another advisory portfolio. If I put in Zerodha, it's very difficult for me to track. So I just put that bucket into a different broker. So if I open, it's only that single platform. No. He loves me. He loves me because he gets everything calculated. I give him the calculator. He loves me a lot. He said everyone should do like that.
I had opened in Stock Holding Corporation of India.
Okay, sir.
It was government bank.
Yes, yes, yes.
That's how it exists here.
Not aware, sir. I can check and get back. I have not opened that. So what I personally checked, I can say with confidence.
There was some mutual fund and few equity also.
Sir, if you message me the name, whatever link, I'll check and get back. That's all.
Stock Holding Corporation of
Sir,
Yes,
but I
it's-
can't get back to you. I don't have your number. If you message me the number and your broker, whatever information I'll share. Please, sir, send me. I'll return it.
Your phone number.
Next slide, please.
Phone number, email ID.
Sir, drop me. Give me 24 hours. I'll check and get back. That's I do. I don't know that answer. If I find anything, I'll.
No.
Last. Thank you slide. Last slide or first slide?
Thank you. Thank you. Thank you.
If today a youngster who has started his practice and earning say about 2 lakhs of rupees
Yes, sir.
salary,
Yes, sir.
and if he wants to invest and come up in life
Yes, sir.
parallel to profession,
Yes, sir.
what is your sincere advice? Like, should he buy stocks? Should he put it in gold? Gold is already up. Silver, Or
Sir,
you said
What I'll
33,
say
33.
probably will be different from what we have discussed, but I always say that's why I'm asking. Okay, so when I started, and I had
No,
not
no,
read,
that
no,
is different
no,
era.
sir,
Today
I'm
is
giving
different era.
same era now.
Like I see a lot of
When I had
youngsters-
my stipend all, I used to save 10%. So that's what my investment used to go in mutual funds, because that time I was not dabbling directly into equity. And other thing is, if you are paying taxes, your PPF is one thing which we should always take, because it's a very good compounding tax-free. So what I do is, if someone is starting to save, I would also say put something in PPF, and then you can look after tax-saving mutual fund, and then after that you can also look at direct equity and ETF. So I think so those products are not to be ignored. Gold probably in the beginning, no, once your investable money is more, then you can add gold a little later. Because the power of compounding will come in these tools.
SGB is the best way to go into gold.
Outside this, a lot of doctors also will have accounted and non-accounted money. How do you say?
Arey, can you stop recording, please? Stop recording. Okay.
In Gujarat, they just talk openly.
Sir,
That's
no,
what
no,
I mean.
recording. I'll talk openly.
Even
Sir,
recording?
sir, doctor's favorite investment is land and gold. Those who are into